Look at the euro to US dollar right now. The price is 1.1603, and the charts are setting up something that most retail traders will completely misread. There is a massive trap sitting just above the most important level on the board, and if you are not aware of it, you are about to get run over. Today, I'm going to show you exactly where the danger zone is, where the hidden opportunity sits, and I'm giving you 3 exact entry and exit levels that you can use immediately. Stay all the way to the end because after the strategy section, I'm going to reveal the one number that decides the entire next week for this pair. Right now, we have a monthly chart screaming strong buy, but look at the weekly, the daily, the 5-hour, the 1-hour, all of them a strong sell. That is a violent internal conflict. The market is trending down hard on every time frame that matters for active traders, yet the longer-term structure is still technically bullish. That is not a contradiction. That is a correction within a bull trend that is now testing the absolute line in the sand. And if you don't understand the cross-asset dollar pressure that is fueling this, you will miss the narrative entirely. There is a growth shock brewing in Europe, and it's about to collide with a technical level that the algos are watching tick by tick. Let's cut straight to the instant market verdict. The session bias today is firmly bearish, and we are treating this as a fading opportunity on any strength back into resistance. The dominant structure is a downtrend acceleration that is holding below all the key moving averages on the 4-hour and daily charts. The one invalidation level that proves this bias completely wrong is 1.1670. If the pair manages to reclaim and close above 1.1670 on a 4-hour candle, the bearish structure fractures and we shift to a range or even a short covering squeeze. But until that happens, we assume sellers are in control. Now, I want you to pull out your trading platform right now and write this number down, 1.1583. This is the support level that matters more than anything else today. If we break below 1.1583 with conviction, the whole floor drops out. The structure shifts from a pullback to a breakdown, and you do not want to be on the wrong side of that. In the comments right now, type the number 1.1583 so I know you're paying attention and you've got the key level locked in. Alright, let's go deep into the technicals. I want you to visualize the daily chart first. The price is 1.1603, and the 200-day moving average is sitting at 1.1589. That's only 14 pips below the current price. A brick wall of dynamic support, and price is clinging just above it. The MA100 is at 1.1681, the MA50 at 1.1683. Those two are practically converged, creating a resistance cluster near 1.1680. The MA20 is at 1.1667, the MA10 at 1.1642, and the MA5 is 1.1620. Notice the perfect bearish alignment. The fast Mars are all below the slower ones, and price is trading below all of them. That is textbook trend continuation pressure. The daily MACD is negative at minus 0.001, still below its signal line, and there is no bullish divergence in sight. The RSI on the daily is at 40.9, which is not oversold, it still has room to fall. That means the momentum is still pointed south, and we haven't even hit an exhaustion point yet. Now, drop to the 4-hour chart. The structure is even cleaner. The recent swing high that needs to be watched is 1.1710, but more immediately, the zone from 1.1644 to 1.1670 is the resistance battlefield. That is where the MA10 and MA20 sit, and that is exactly where the sellers keep reloading. Every bounce over the last few days has been capped inside that band. The daily support numbers I gave you are 1.1583 and 1.1550. On the 4-hour chart, 1.1583 is not just a horizontal level. It's the exact prior swing low from a couple of weeks ago. A break of that level will trigger stop hunts and cascade sell orders, likely driving price straight into 1.1550, which is the next structural support. And below 1.1550, there's a vacuum down to the 1.1500 big figure. Here's what most traders miss. The monthly trend is still a strong buy. That means if we reach 1.1550 or 1.1500, we are deep in a value zone where long-term buyers could start stepping in. So the breakdown trade is a short-term momentum play, but the real battle will be between the bears trying to smash through and the bulls attempting to defend the monthly trend. This creates a phenomenal trading environment if you know where the levels are. On the 60-minute chart, price is consolidating right around 1.1600, with very tight ranges. The moving averages are compressed, which means an explosive expansion is imminent. When you see price coil right above the 200-day moving average, it's like a snake about to strike. The MACD on the hourly is flatlining near zero, which is not a reversal signal, it's a pause before the next leg. We are in the calm before the storm. The next signal changes everything. A 60-minute close below 1.1580 will trigger a rapid move lower. If we get that, I want you to watch the volume. Any spike confirms the algos are piling in. Let's weave in the cross-asset narrative because this euro weakness is not happening in a vacuum. The US dollar index is pushing against key resistance, and the dollar killers, euro to US dollar and pound sterling to US dollar, are both bleeding. Sterling is showing a similar pattern, facing its own domestic doubts, but the common thread is a dollar bid driven by safe haven flows and relative growth outperformance. And this brings me to the fundamental driver that lit the fuse. The 24-hour core news is clear. Eurozone growth is weakening. The latest data and commentary point to stagnation in the core economies, while the ECB is stuck in a policy bind. They cannot hike aggressively because the economy is rolling over, but inflation is still sticky. That divergence with the Federal Reserve, which still has the option to hold rates higher for longer, is crushing euro rate differentials. The bond spread between US and German yields is widening in favor of the dollar. This is the macro engine of the down move. When you see an article like euro to US dollar faces deeper pressure as Eurozone growth weakens, that is not a random headline. That's a warning that institutional flow is repositioning for a prolonged euro underperformance. Yesterday's ECB speaker comments were dovish enough to reinforce the idea that the central bank is now more worried about growth than inflation. That is a policy pivot signal, and the market is pricing it in ruthlessly. At the same time, look at pound sterling to US dollar. The Bank of England narrative still has some hawkish remnants, but the pound is also falling, which tells you the dollar strength is the master variable. The euro-pound cross rate is also slipping, meaning the euro is the weakest link in the dollar-killer duo. My 1 to 2 week directional lean is bearish on euro to US dollar, targeting the 1.1500 region, but this thesis would be invalidated if we get a sudden dovish surprise from the Fed or an upside growth shock in the Eurozone. The exact event to watch is the upcoming flash PMI numbers. If they surprise to the upside, the shorts will get squeezed. Otherwise, this downtrend has legs. Now we are at the part that most people skip, but this is exactly where money is made. Keep watching because I'm about to hand you 3 concrete setups with exact entries, stops, and targets. If you're serious about trading, this is where you take notes. Strategy 1, the sniper. This is the conservative, high probability breakdown trade. The trigger condition is a decisive 4-hour candle close below 1.1580. I'm using 1.1580 because it's just below the 200-day moving average at 1.1589 and below the key support of 1.1583, giving us a structural break confirmation. Do not enter on a wick. Wait for the close. Once confirmed, enter short at the open of the next candle. Your stop loss goes at 1.1645. Exactly above the MA10 and the top of the daily resistance band. The logic is simple. If price recaptures that zone, the breakdown was a fake-out. Risk is 65 pips. Take profit 1 is 1.1550, which gives you a 30 pip gain and a risk reward of roughly 1 to 0.5. That's modest, but take profit 2 is 1.1500, a 100 pip target, delivering a risk reward of over 1 to 1.5. You scale out half at 1.1550 and move the stop to break even on the remainder. What voids this setup entirely is any strong bid appearing at 1.1583 that pushes price back above 1.1620 intraday before the close. This is a high probability sniper approach. You wait for the market to confirm the breakdown, Then join the momentum. Strategy 2, the active trader. This is for those who want to play the resistance zone and capitalize on the ongoing bearish structure without waiting for a breakdown. The entry condition is a pullback into the 1.1640 to 1.1644 area. That's where the MA10 lines up and previous intraday. Sellers have stamped their authority. You want to see a bearish rejection, a shooting star or a long upper wick on the 15-minute or 60-minute chart, confirming that the offers are heavy. Enter short at 1.1640. Stop loss at 1.1685, above the MA50, MA100 cluster and the resistance ceiling. That's a 45 pip stop. Target 1 is 1.1583, the key support, for a 57 pip gain, giving a risk-reward better than 1-to-1. Target 2 is 1.1550, a 90 pip gain, risk-reward 1-to-2. Once target 1 is hit, trail the stop to 1.1620, just above the MA5, to lock in profit and allow the runner to capture further downside. If price fails to reach the entry zone and just grinds lower from here, you simply sit on your hands. The active trader does not chase. The active trader waits for the retest. Now, before I reveal strategy 3, let's get an interaction going. Type your euro to US dollar range for tomorrow in the comments right now. High and low estimate. I'm reading them. Let's see how aligned we are. I'll drop my own projected range in the pinned comment later. Engagement is a two-way street. I want to see your bias. Strategy 3, the aggressor. This is high risk, strictly for those who understand that losing small is part of the process and who can manage risk aggressively. This entry is for the momentum trader who believes the current 1.1603 price will continue its push toward the 200-day MA and break it today. Enter short at market, right at 1.1603. Place a tight stop loss at 1.1635, just above the MA5 and the consolidation range high. That's a 32 pip stop. Target 1 is 1.1585. A quick 18 pip scalp to capture a test of the support. Target 2 is 1.1550, a 53 pip target, a risk reward of 1 to 1.6. The setup is based on the strong sell on multiple timeframes, and the idea that price won't even manage a meaningful bounce into the resistance zone. If price trades back above 1.1635, you're out immediately, no questions asked. Do not use this strategy if you are not comfortable with a lower win rate. This is a chase play that profits when the market accelerates and punishes if it chops. Let's pause for the risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No position should be held through high-impact news events like PMI releases or central bank speeches, unless you are hedged and fully aware of the volatility. Stops are non-negotiable. Set them immediately upon entry. So here we are at the close. If you forget everything else, remember this one level, 1.1583. That's the number that will define the next session. A daily close below it flips the bias to accelerated sell and targets 1.1500. A rejection and bounce above 1.1644 signals a deeper corrective squeeze. Tomorrow, I'm going to focus on the US dollar to Japanese yen and Nikkei 225, where the intervention ghost is whispering again and the yield differential drama is reaching a boiling point. That video will be crucial to understand if the dollar rally is about to get another leg. From the yen side, the cross-asset thread is tightening, dollar strength, euro weakness, yen fragility. It's all connected. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now, and the end screen will take you straight there. We are tracking the risk asset shadow and the funding rate anomaly that screams a liquidity grab is coming. Do not miss that. If this analysis gave you a clear plan for euro to US dollar today, smash the like button. It tells the algorithm to push these daily institutional insights to more serious traders. Subscribe and hit the bell so you get all 8 asset breakdowns every single day without missing a beat. Comment the number 1.15831 more time if you're locked in, and I'll see you in the next one.